In 2026, the tax code doesn't need new rates to change what you owe. It can change simply because the IRS inflation adjusts income thresholds, reshaping your taxable income math. Let's build a practical 2026 game plan using 4 ideas: bracket shifts, filing status, deductions, and credits. First, a quick reset on how brackets actually work. The US system is marginal, not flat. Only the portion of income that falls inside a bracket gets that rate. Moving higher doesn't tax all income at the higher rate. Now the real 2026 update: bracket thresholds moved up. For single filers, 10% up to $12,400, 12% up to $50,400, 22% up to $105,700, and 24% up to $201,775. For married filing jointly, 10% up to $24,800, 12% up to $100,800, 22% up to $211,400, and 24% up to $403,550. These thresholds determine where your taxable income lands. Here's the first case of a silent shift. A small raise or retirement withdrawal can slide into a higher marginal tier. With planning, you can keep taxable income in a lower bracket by adjusting timing of withdrawals, capital gains, or Roth conversions. The core strategy for 2026: align your projected taxable income with specific thresholds. You need a target. If you're single and near the 24% bracket, your best planning may not be complex investments. It may simply be managing when income and deductions show up, keeping taxable income on the favorable side of the threshold. Next, filing status. It's not a small checkbox. It's a full set of tax brackets with different thresholds. For married couples, filing jointly versus separately can dramatically alter where higher brackets start. Married filing separately often compresses top-end thresholds, pushing you into higher rates sooner, leading to a higher total tax bill. Filing jointly usually widens bracket thresholds, lowering combined marginal exposure, especially for couples with varied incomes. Filing separately can create bracket compression and eligibility problems. Model both outcomes. Your status determines your bracket map. Now let's talk deductions. They decide whether your income even reaches those brackets. In 2026, the standard deduction is $16,100 for single, $32,200 for married filing jointly, $24,150 for head of household, and $16,100 for married filing separately. A large portion of income may never reach the bracket table. This is where many misjudge itemizing. It only helps if your itemized total is higher than the standard deduction. Mortgage interest, charitable contributions, and medical expenses matter. The biggest swing item for many is state and local taxes. If the SALT cap is higher, itemizing becomes more common, but it depends on your full stack of deductions and income. A powerful planning technique is bunching deductible expenses. Concentrate charitable giving into 1 year. This ensures itemizing beats the standard deduction, then take the standard deduction in alternate years. Another example is timing large medical procedures into 1 year, as expenses are deductible only if they exceed a percentage of AGI. The planning value is less about the procedure and more about the year you choose to recognize it. Now, credits. Credits are not deductions. Deductions reduce taxable income, but credits reduce your tax bill directly. A $1,000 credit reduces tax by $1,000, while a $1,000 deduction reduces tax only by your marginal rate times $1,000. That's why credits are often the most valuable part of the system for eligible households. In 2026 planning, the child tax credit remains a major item for families, with a $2,200 maximum baseline. The exact benefit depends on income, phase-outs, and eligibility. Credits are the most powerful dollars in your tax plan. Education incentives can matter too, but they often have phase-outs and eligibility details. And there's another subtle trap. Some benefits are based on MAGI, not taxable income. That brings us to IRMAA. Tax brackets are based on taxable income. IRMAA, Medicare premium surcharges, is based on modified adjusted gross income, or MAGI. It uses a look-back system from a prior tax year. You can be fine on your tax bracket and still trigger an IRMAA surcharge. This happens if your MAGI crosses an IRMAA threshold. People are shocked after large one-time events. A Roth conversion, big IRA withdrawal, capital gain, selling property, or a pension lump sum can raise MAGI. MAGI can affect Medicare premiums even if you expected only a tax hit. If you're near an IRMAA threshold, the goal is not just managing the marginal bracket. The goal is managing MAGI exposure across years, especially for one-time income spikes. A smaller conversion spread across 2 tax years can sometimes reduce total costs when including taxes and Medicare surcharges. The decision isn't emotional, it's arithmetic. Now let's turn this into a proactive 2026 action plan. Step 1 is projecting. Take your expected income sources for 2026: wages, Social Security, pensions, RMDs, dividends, interest, and plan sales. Then estimate deductions, standard versus itemized. That gives you an approximate taxable income range, which you can map to the 2026 bracket thresholds. Step 2 is stress testing the what-if items. Ask what happens if you take an extra $10,000 from your IRA, or if you do a partial Roth conversion, or realize a capital gain. You're checking where those dollars land, relative to bracket thresholds and MAGI-based cliffs like IRMAA. Step 3 is payroll and payments. If you're still working, withholding is your first lever. If self-employed or with significant investment income, estimated taxes matter. Avoid a surprise bill or overpaying. Step 4 is documentation. People lose deductions not because they were ineligible, but because they can't support the claim. A clean system for receipts, medical tracking, charitable letters, and brokerage statements reduces stress and makes filing faster. Finally, the 2026 tax landscape is about alignment, income timing, filing status, deduction strategy, and credit eligibility, with a separate lens for MAGI-based costs like Medicare surcharges. Treat these as one integrated system. When you do, you stop reacting in April and start steering the outcome throughout the year.